Good afternoon, ladies and gentlemen. Happy Friday, December 29th, 2017 to you all. Congratulations on making it through another trading year. It's about a half hour ago, of course. We were ending the last time we could do any of our trades or adjustments for the 2017 calendar year. And of course, we're heading into the New Year's Eve, the holiday season part 2 this weekend. Markets will be closed on Monday, January 1st, and we'll be back at it January 2nd. And of course, before that, we're going to have our end of year open forum Q&A session as we do every Friday. So I hope you all had a profitable year, or you had a successful trading year. And again, made it through this year, and will be interesting to see what 2018 holds in store for us. My name is Mike Chupka. I'm the Director of Education here at Power Options and at Radioactive Trading. Welcome to the webinar. I hope you brought your questions. All right. So I always want to begin this presentation with what is Power Options. Power Options, www.poweropt.com, is a patented suite of search and analysis tools for self-directed options investors. Ernie Zerenner designed these tools back in 1997, and it's designed to be a one-stop shop for options investors. You can search for positions by strategy based on your criteria, or by strategy one stock at a time. Look up multiple strategies, one stock at a time, for comparison using our search summary tool. Then, of course, we also have tools to help you further research and analyze the stock or the options, run what-if scenarios, and of course, you can use our portfolio tools to track your positions, evaluate adjustments. Our position analysis tool, if you're tracking positions in the portfolio, will allow you to analyze rollout opportunities and compare before and after pictures of making an adjustment. Of course, in addition to that, we do offer countless help videos, flash tutorials, white papers and articles, blog articles, and archived webinars to help you get more familiar with the tools on the site and the various option strategies. Ernie Zerenner created the Power Options tools back in 1997. Of course, everyone here on staff uses these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, our process and procedure for this afternoon's presentation. When you logged on to the webinar, GoToMeeting, GoToWebinar platform appeared on your screen. Inside that platform is a question pod, so just use that question pod to send us a question at any time during the presentation. Please feel free to ask any questions as you want, or as many questions as you want at any time. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. However, if we do have a high volume of questions, we'll be more than happy to stay online to make sure all questions are answered. Questions can really be about anything related to options or options investing. You might have a question about a general options strategy. What type of structure works best for a covered call? What do you look for when entering a bull put credit spread? I see some questions coming in on diagonals, it looks like, as well. That's all fair game. If you have questions about trade management, what should I do to look for to adjust a position that's moved against me, whether it's a spread or a standard long option, even a long call or a long put? What triggers would we use to manage a bull put credit spread, a bear call credit spread, and so forth? You may have questions about options specifics or even options basics. What is delta? What is gamma? What is theta? What is the difference between IV rank and IV ratio? What should I look for as far as volatility skew? And that's all fair game as well. Now, you may, of course, have questions about using the tools on Power Options, setting up a search screen to match your criteria. How would you go about doing that? Please feel free to send those to us as well. And, of course, some of you may have questions about the concepts of the limited risk radioactive trading techniques. That's all fair game, too. Our basic ground rules, don't be shy. Please feel free to ask any questions that you want at any time during the webinar. Be patient. There might be one or two questions ahead of yours, but as I mentioned, we will get through them all. We're actually going to start off with a question that came from email that's going to apply to everyone, and we're going to allow everyone to chime in with their thoughts also. I encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience, what I've done in my personal account, But you have a different way of analyzing a position, evaluating an adjustment, or a different type of rollout opportunity or adjustment you use in your portfolio. I encourage you to share that with us. Now, I may ask you for clarification on your question that comes in. There are a lot of different educators out there, quality educators, don't get me wrong, but they might use different terms for something than I commonly use to describe a strategy. For example, you may have come across a webinar where someone was discussing the advantages of something called a jade lizard. Well, I might ask you to clarify what is involved with a jade lizard, as I might call that something else. Or we had a webinar a few months ago where someone asked about a three-legged box spread. And I didn't know what he meant by a three-legged box spread. It was sort of a marketing term another service was using for a synthetic long call or synthetic married put, for example. Okay, so I may ask you for clarification. Don't be offended, and don't think it means any less of my education and options. There's just a lot of different terms that are out there and a lot of terminology that's used that I might not use to describe a particular strategy. Most important, let's have fun. It's the end of 2017. Whole new year ahead, whole new opportunities ahead. We don't know what's in store for us, but that's why we're here, to help you with your positions, to help you with your strategies, and make sure we're ready to go. All right, so our first question, it came in via email prior to the webinar, was from Harry S. And Harry asked, for today's webinar, can you review the options trading brokers for 2018 and who you recommend? Or if you're not able to recommend, some pluses and minuses. Also, can you compare the research services offered by the options brokers against the Power Options service? Well, my direct answer to Harry via email was, I can try, but in general, I cannot compare all of the services available on other brokers unless I have an active account, meaning I'd have to open brokerage accounts in 15 to 20 different services. Really, I'd focus on the top 7 or 8, but I'd have to go through and use all their tools and write up a review and everything along those lines. So I'm not willing to do that, but I will say the most popular options brokers, they're not in any real order, based on discussions I've had with customers, what my customers are using, what I see online and so forth, would be Interactive Brokers. They've been around for a while. They started out kind of smaller, started out as a competitor to some of the other bigger services. Tastyworks. This is a new service that has come out of Tom Sosnoff's Tasty Trade discussion. They opened a brokerage house within the last 8 months, 5 months, I believe, called Tastyworks. Thinkorswim is still popular. They're now pretty much absorbed into the TD Ameritrade view, the TD Ameritrade portal. Options Express, which is really now Schwab, part of Schwab, for example. Options House was a popular one, as well as Options Monster was one that I was considering using for a while, but Options House bought out Trade Monster / Options Monster, and now Options House is part of E-Trade. So I'll say E-Trade in there instead of Options House, but they integrated some of the Options House tools, I believe. TradeStation is always a popular one. The Fidelity and Fidelity Pro, I actually use that myself. I don't have any issues with it. I'll talk more about that. And there used to be a service called Trade King, which is now Ally Invest. So Ally Invest essentially just grabbed Trade King and incorporated it into their services, as TD Ameritrade did with Thinkorswim and Schwab did with Options Express. Okay. Now, I could talk about a few of them. Interactive Brokers. It's a low-cost brokerage service. I just put up exactly what I found on their website here for their costs. So for the United States, of course, they have different tiers also. Depending on your trading account size, they offer different structures, I should say, different commissions. And at the same time, they offer different ones for international. But you see here, this is for their options, and it's under $10,000 of monthly contracts. They have other tiers. If you're 10,001 contracts to 50,000 and 50,001 contract to 100,000. I'm nowhere near any of that. But for a more active broker, they have good discounts if that's how much you're trading. So they usually charge about 70 cents per contract based on premium, I guess, but they do have a minimum of $1. And they also say this is for options, okay? This is on their options. Stock was listed differently. They say 5 cents per stock with a $1 minimum. Okay, I think that's 5 cents for one share of stock with a $1 minimum per entry, and then so forth. Now, the one thing I can say about Interactive Brokers is that early on, there was a lot of commentary, some of it negative, with their customer service. They came out many years ago. This is not even an issue anymore. I just mentioned it, so if you read about them online and you see someone mention that their customer service was poor, that was from many, many years ago, because they really wanted to have a low overhead as far as support and other things go. And they designed themselves to sort of be for an active options investor. And then over time, they enhanced their tools for the more intermediate or beginner options investor, increase their support staff, increase their education, enhance their tools. When they first started, they were purposely trying to be bare bones as possible to keep the overhead low. Their commissions are extremely competitive. I've heard that they're the best out there in comparison. I know they have good profit and loss chart tools for analysis. I don't think they offer a screening tool the way that Power Options does. I don't think most of the brokers do. A lot of brokers I know, you can run a stock search, meaning you can run a search for stocks that you'd want to see that offer a certain liquidity, a certain trading range, fundamentals and technicals, and some of them are pretty robust. And it'll spit out a list of stocks. But then you have to go into the options tools and say go into a spread view and then enter one or two stock symbols at a time to see the spreads on that particular stock. So you can't say show me all spreads across the universe of options that have this stock criteria and also have this probability, this minimum net credit, and then just see all the results across the universe of options. Okay. One of the reasons a lot of services don't do that is because that's what our search tool does, and it's actually patented. So creating something exactly like we have would be infringing on our patent. But again, without having an actual account, which I don't have in Interactive Brokers, I can't tell you. I'm basing this on feedback I've received from customers over the years. Now, Tastyworks, again, is brand new. The brokerage arm of Tastytrade, formed by Tom Sosnoff, who was one of the original members of Thinkorswim. I have no idea on the tools, the charts, the analysis they use. I know they offer good education. They eventually took a lot of the informative education that they have over at Tastytrade and imported it to what you'd need to be able to trade and show you how to trade their tools inside of Tastyworks, I believe. So I'm assuming that they have good tools for options investors because it was designed based on what they do, how they teach their strategies at Tastytrade, and more. One of the advantages I think customers told us in August, and during a webinar even in August, is that you can see here it's $5 opening trade, but for unlimited shares, right? So it's not the $1 minimum and then 5 cents extra for each share. And opening trade is $1 per contract. And then, of course, there's mentions of futures as well. But one of the advantages they have here is that they claim to offer no fees for closing a trade. If it expires, they buy to close, or they do something else along those lines. So that's something to keep in mind as well. You know, they say here there's an asterisk, of course, it's in red, and then it says commission plus applicable fees, but it says $0 for closing trade. So there's some other fine print in there, and I'm not sure what it is. Now, I put this one up here too, and this is sort of just along the lines here. It's a former Trade King, so Ally probably took most of the tools there for their options, but sort of put Ally Financials, Ally Invest, coloring, markers, and definition on it. I like Trade King's tools from years back. I don't know what was kept. I do not remember a search or a screener, as I mentioned before. You could search for stocks, and then you have to go into a spreads format or covered calls format, 1 or 2 stocks at a time to see the view. All right. You see here they offer special rates, $3.95 per online stock and ETF trade and 50 cents per contract, but with a $3.95 base. Okay, so minimum of $3.95, then 50 cents for each contract. But that's their best pricing, and it's based on $100,000 average balance or 30 or more trades per quarter, which 30 or more trades per quarter I think is achievable for most active options investors as well. And then their standard rates are a little higher, $4.95, no minimum trade activity, no minimum account balance, $4.95, and then $4.95 base for the option is 65 cents. So you actually get penalized for trading less frequently and, of course, having a lower size account as well. And I'm not going to spend too much more time on this. What I wanted to mention is that I'm getting these screenshots and ideas directly from other websites, okay? You're going to have to spend time comparing them on your own. Go to those brokers that I mentioned and go through. They'll have listings of their products, their investing tools or technology. They'll have videos on searching. They'll have videos on portfolio analysis or profit and loss chart analysis and their graphics tools and how to establish it. So you've got to go through those yourself and see which one appeals to you by look and feel, how you invest, how active you are, and which ones you feel are too complex. Okay. Now, I've heard rumblings about investors who were diehard Thinkorswim fans for years and years because they sort of bucked the trend and it was touted as being designed for options investors and options investors only. Very competitive pricing. But I've heard rumblings within the past 8 to 10 months that too much of TD Ameritrade is getting filtered into the Thinkorswim tools. If anyone wants to comment on that, if you're using Thinkorswim, let me know. That's just something to mention. Over the past 2 years, I've personally seen sort of slowness on Options Express. I do have an account there, and Schwab. Sorry, I missed the H there. Just trying to, when you log in, it sits there and spins for a minute. When you open your portfolio, it sits there, kind of spins and thinks for a little bit. Is not as quick as some of the other websites. My main trading is done at Fidelity. Fidelity Pro can be used as well. It's a robust tool. It's very useful. I don't have any issues with Fidelity, but I have to mention that by the time I log on to Fidelity or when I would use Options Express more actively, I already knew what I was doing. Everything that I would have done as far as research, analysis, rolling or adjusting a position, the prices I want, was all done on power options. I would simply log on to Fidelity to make a trade. I didn't look up anything else. Once or twice, excuse me, I may have logged on to Fidelity to verify a pricing. Sometimes I get a phone call from a customer and he says, I'm looking at your chain on XYZ and the out-of-the-money 25 call shows a bid of 30 cents and an ask of 45 at my broker, and you're showing $1.10 and an ask of $1.15. Why is your data wrong? 99% of the time, what happened is an investor was looking at a March 25 strike option on power options and was looking at a January 25 strike option at their broker. So our prices weren't wrong. They're just looking at the wrong expiration by mistake. Sometimes that happens often with the weeklies. You're looking at week 2 instead of week 1 on 2 different services and the prices aren't matching up and it's just accidental different expiration. So again, I've done that before. And E-Trade, I know, as we mentioned in that first graphic, E-Trade, of course, has now absorbed Options House, which had previously absorbed Trade Monster / Options Monster. But I know E-Trade and TradeStation are always improving their tools for that. Another thing I should mention, I don't think it appeals to a lot of us online today, but I saw an advertisement on TV the other night watching a hockey game, Predators and Blues, from the St. Louis broadcast. And TD Ameritrade had a cute little commercial with 3 sort of guys my age, 40, 42 years old, sitting around a man cave bar, and one of them just started talking about options, and the other 2 were intrigued, and they said, well, where can we learn more? TD Ameritrade is pushing a new beginners level, full forum, free for their customers, options trading. I don't know how involved it's going to get. I don't even know what strategies they're going to talk about, or if it's just really basic from the beginning to get more investors in at the top of the so-called funnel who are only trading stocks or mutual funds and want to take more control of their investing, as we all were at one point in our lives as well. So that's just something to mention that I've seen as something to consider. One last graphic on this topic that I'm going to get to your questions, and got some here. Good point. I'll mention this too. Paul says he uses Thinkorswim. Thank you for the feedback, Paul. I appreciate it. No one else has the on-demand database for backtesting. All right, we have backtesting tools, but Paul says they have an on-demand database for backtesting. In addition to that, I didn't think to mention this, Paul. It's something that I have a problem with too. On Fidelity, they don't have, and some of the other brokers might have this too. As many of you know, I trade married puts and I trade collars. But at Fidelity, unless you're on Fidelity Pro, you can do a married put. But at Fidelity by itself, You can do covered calls, and they have a spread view, but you can't do a three-leg collar trade. There's not a one-ticket entry for a three-leg collar trade at Fidelity. And on the standard Fidelity, non-Fidelity Pro, you have to enter the stock and the option for a married put separately. Paul says it's likewise at Schwab. See, Options Express, I haven't checked recently, but I used to trade collars all the time, standard collars at Options Express, and they had that. I was able to do the three-legged collar there, but I guess they might have changed it when Schwab absorbed them. That's kind of interesting. But anyway, the big ones here, this was from stockbrokers.com, okay? The reason why I'm not doing a whole webinar on brokers and everything else is places like stockbrokers.com, and there's a couple of others. They've already done these comparisons, and they do them every year. This is a much better resource than what I have to offer. If you're interested in just talking of commissions and fees, offering investments, platforms, and tools, and you got to ask yourself, well, who's actually doing all the rating here? Customer service. You look at some of the numbers, and you might think, well, TD Ameritrade might have sponsored this stockbrokers.com. We don't know, but who knows? It could be completely independent. I think it is, but they have full reviews on different services as well, so you want to check them out. But you see here, most of them are all in line as far as overall. The commissions, as we talked, Interactive Brokers is up the best. Options House is right with them. And TradeStation and Charles Schwab a little bit more expensive, as is TD Ameritrade. But the investments offered, platforms and tools, you get the higher ratings at TradeStation, Charles Schwab, and the full rating at TD Ameritrade, only a little bit less for Options House. Research, it looks like Charles Schwab is the best based on this rating, and TradeStation is the worst. And TD Ameritrade is pretty good. The customer service, they're all in line. Question mark about Interactive Brokers. Getting better, as I mentioned, but still they were designed for self-directed investors and wanted to minimize their customer support level. Mobile trading. I don't know if that's important to all of you, but mobile trading, they're all pretty good. The best ones, again, TD Ameritrade, Options House. Ease of use is probably the most important. Why? Because I know, for example, Interactive Brokers offers a ton of tools for options investors for in-depth analysis that I myself wouldn't use. Not because I already know what strategies I'm looking for and I use power options, I'm sort of ingrained in that. I'm sure the tools at Interactive Brokers would help me further research and analyze, but sometimes you get too many bells and whistles, and it actually stunts you or hurts you from making a trade because you think you have to look at all these different criteria and all these different widgets that are being offered. Narrow that down a little bit. You might not need to be that involved. This is an interesting one. Order execution, Interactive Brokers at the top. I feel that's important. Charles Schwab is up there. I have no problems with Fidelity's personally order execution. I put in midpoint. I usually get it within 10 to 15 minutes. And Fidelity has also recently, when I've been placing trades, probably in the last 5-6 months, might even be a year, but I'll put in a midpoint order to sell a call. Let's say it's the bid 75 and the ask is 85, and I'll say, okay, I'll try 80. And all of a sudden I get filled a second and a half later, and they actually got me 82. Well, okay, it's nickels and dimes, but I'll take that. They've been really good at getting you a better price for selling and a better price for buying, even potentially higher when you're selling from the limit order you put in, or lower for the limit order you put in for the ask. And then doing the banking off of it, of course, naturally, Ally Invest, it's not listed here, but Charles Schwab and TD Ameritrade are actual banks. These others are not. Okay, so there's more comparison. You could do more research at stockbrokers.com. So Harry, that's the best I can give you. Again, comparing the tools on these sites to power options, I already talked about the search tool. I don't know if you can search across the universe of options in a given strategy on these websites as you can on power options. I know that our portfolio tool, I know a lot of these other places have what they call a portfolio lab or analysis. I know our portfolio shows rollout opportunities based on what our customers do in the given positions. I know you can easily click on some of these websites from your existing position and go to a sort of analysis view and click on two buttons and substitute A for B and see a nice pretty graph with the third way out, halfway out, and 3/4 of the way out to expiration and expiration, what it would look like, and if you added this and minimize this. I'm just so used to our format. I like that better than seeing lines and actually seeing the numbers and the percentage return and so forth. You see that too. another quick thing here. I'm going to move over to the Power Options suite of tools real quick. So we're going to use that for our next questions that have all come in during this discussion. But sometimes I receive, and again, this is just me being so used to Power Options that I don't, that I'm so used to it. Someone sends me a screenshot of a position. Now, Sam, you send me screenshots of your charts of the recent trades you had. That Watt one was really good that you sent today. I'm sorry, I was working on some of the stuff for promotional emails. I didn't get a chance to answer your last emails from yesterday afternoon and from today. Sam's with us, of course, as well today. But in any case, I'll receive a screenshot of someone's analysis chart of a 3 or 4-legged position they have. And I'm staring at a screen that's black with what looks like a profit and loss chart of a ratio call spread with maybe a broken wing butterfly. And then I try to look down and see the actual trade. And it's 12 columns. And I'm struggling to even find the strike price. So it's a little small widget on the bottom which shows 12 columns for delta, implied volatility change, gamma change, all these other things. And I'm staring at this, and I consider myself reasonably educated in options investing and options trading. And I know how hard it can be when someone first new comes to Power Options, how different it could be because you don't typically see that on a regular basis. But at the same time, it overwhelms me. So I have to ask the customer, what am I looking at and what is your exact position, because I can't figure it out from the screenshot there as well. Okay. All right. So let's just wrap that up there, and let me make sure I'm on the right screen here. We'll jump into John's questions. He's been patient and he sent them in right away. Okay. So John wants to know, Mike, what's your take on short-term double diagonals? And what does the checkbox for always use current market prices mean? Okay, so there's two things there. First, a double diagonal. Now, do I have calendar spreads up? No, I don't. Let me go to calendar spreads. Take that out. So I'm going to the Other Strategies tab, and we're going to go ahead and select Calendar Call from our menu here of available strategies, and didn't add it. There we go. Let's go ahead and save that configuration. Let's go to calendar spreads. This is the main homepage. Now, of course, a calendar spread is defined as buying an option, a call or a put that is further out in time, and then selling a closer in call or put, similar strategy. So I might create a calendar spread by buying right now a March option, a March call, and selling a near-term call against it. Now, the original common diagonal calendar call spread, I should say, is when I'm buying an at or in the money call. So if our stock's at 50, I might be buying a March 45 or 47.5 and selling the 52 or 51 strike weekly or 2-week out option. Okay, so some people refer to this as the poor man's covered call, because instead of buying stock, I'm buying a far out in the money option. And I could buy a year out leap. It could be 3 months out the option I'm buying. You can do different combinations, but as long as this option is further out in time and at a different strike, it's called a diagonal. If they're at the same strike, it's called a horizontal. Now, what John is asking about is typically a different structure. Instead of what I've seen and described, instead of buying an in-the-money call and selling an out-of-the-money call, or if I bought an in-the-money put and sold a near-term at or out of the money, which would be the opposite spread, when you do a double diagonal, you sort of create what looks like a dipped or curved iron condor strategy. But it's done differently, in the sense that typically here what I see is investors where I'd buy the in-the-money put and sell the at-the-money, they're buying an out-of-the-money call far out and selling the at-the-money, and selling the at-the-money put and buying a far out-of-the-money put. No, there's nothing wrong with that. It's just a different structure. I currently don't have this as a search function on Power Options, but we'll take a look at a standard example here. We'll just go to the custom spread tool, and I'm just going to build one on Apple based on what I think we'll be doing. And we'll just go 21 days out to standard January expiration. You can do weeklies, that's fine. So now I'm selling. These are the near terms I'm selling. I want to give myself a little bit of breath. So with a stock at 169.23, good price, if I'm neutral-ish, I may sell the 172.5 call, about one strike out of the money. Let's go ahead and buy, let's buy, and then I'd sell the 165. It's really close, but again, this is a neutral position, just like an iron condor. Okay, I really don't want the stock to move in the first 15 to 20 days. Now, this might be too close for some of you. I understand. You might want to go further out of the money. But the double diagonal, what I would do now is let's go out to, well, they have April's. February? Now, let's go to April, where I might consider, quote unquote, the poor man's covered call or standard diagonal calendar spread. I might buy a 145 or 150 call on Apple and sell the 175. Here, we're going to buy a cheaper out of the money option, essentially a calendar bear call credit spread with a calendar bull put credit spread. That creates the common double diagonal. So I'm trying to lower the cost by buying further out of the money. I sold the 175. I want to keep it a 10-point spread. I buy the 185, and I sold the 160? Which one was I'm selling there? 165, excuse me. So I'm going to keep that a 10-point spread and go to the 155. It's pretty expensive. All right. So there's my structure. I'm selling the two near terms. I'm going to buy the far terms. Okay. Get to your second part of your question, John, just a second. Let me go ahead and run that. So here's a typical double diagonal. This was 21 days out in time. As I mentioned, it's very similar to an iron condor. I want the same thing to happen. In this case, I want the stock to stay right between these strike prices at expiration. Okay. The short option, short call, and the short put that are out of the money are covered by the long options that we bought. The idea behind the double diagonal, why is a double diagonal maybe better than an iron condor? Well, it's because I have these long term. And it was done at a debit. And because it's done at a debit, there's usually no monetary requirement. But some brokers may charge a margin requirement between the short call and the long call. Because remember, I sold a near-term 172.5 call. Oh, I'm sorry, I bought the wrong call. That's okay. And I bought a 185. So between those two strikes, at January 19th expiration, yes, I have something out to April, but when it's between those two strikes, I got to do something to cover this short call or cover this short put. Okay? Broker may not automatically exercise my long to deliver the short. What do I mean by that? The stock, say, fell, sorry, grab the highlighter. If the stock fell to 160, right about at our break even or a little bit below it, at January 21st, I have an obligation to buy 100 shares of stock at 165. Now, I do have an April 155 put. That's still out of the money, right? So if I haven't managed it by now as the stock went through the short put strike price, I may end up buying shares of stock at 165 or having to cover a margin requirement. Same thing on the short call side if it's between the strikes, okay? So that's one look at the double diagonal. What are my thoughts on it? Well, it's the same as an iron condor. You've got to be neutral. You might go further out of the money in this case for a lower maximum return. The advantage of a double diagonal over an iron condor is we've already paid for these options that are out to April. So on January 21st, the stock does what I want, stays at around 171 at expiration. You know, maybe it went up to 174, then came back down to 162, then so forth and so on. But it ends at 171. Well, both options, as they would in a condor, expire worthless. But I'm still holding these long Aprils. I could liquidate now and take the profit, or sell new strikes for February. Maybe now, depending on my outlook for the stock, maybe sell the February 175 call with the 185 call still in place, and then sell the 165 or 167.5 put now, and with still having the April put in place also. So it gives you more time to manage the position. Now, your question, John, you asked about short term. So what I'm assuming you meant there is that, if I did a 1 week out spread, for example, if I sold next week's instead of this structure, we keep kind of the same structure, but I sell 1 week out the January 5th. Yeah, see, now the prices are extremely low, but let's say we sold the 175 again and the 165 for our sold, but then we only bought 3 week out options. And again, kept the same number as we did see, now you've got all the different strikes in here. That's okay. Do the 185 call and the 155 put again. So this is shorter term, which means you're going to have potentially a lower profit. You can receive, in this case, I did receive a credit for this position. Yeah, okay, so I did receive a credit. It did add a monetary requirement here, so the risk on the monetary requirement is only 4.8%, looking for $47. You see that it's the same kind of structure as this, as an iron condor, but instead of doing an iron condor for next week, thinking the stock would be between 165 and 175, the two short options, and then doing it on Apple again for the week of the 12th and doing another 4 commission trade, and then again on the 19th. Here you would just be rolling ones or letting these two expire and then opening a new short call and a new short put for the 12th expiration, then another one for the 19th, so you actually end up in an iron condor. Okay, yeah, so sell 1 week out, buy 2 weeks out, in this case 3 weeks out. You buy the 2 week out with the same structure, you're going to be paying less, but now you've got less advantage of doing this over an iron condor because it's so close. Okay, so I was at the 185, very cheap, 155 as well. So we're keeping the same shorts to January 5th, but now we're buying 2 weeks out. So it's really short term, not 10. Okay. So $39 in this case on a wide spread compared to, what was it, $47 for the 3 week out. Because why was the maximum profit higher by paying more money? It's because this is based on the first week of expiration, John. So at that time, the 2 week out options, the January 19th, would have retained more of their time value than these shorter term ones. Once we get to next Friday, the value of these two long options, depending on where the stock is, but they're going to get closer to zero. Okay, so without any comparisons done on my part on this, I'll give you my thoughts here. Number one, double diagonals are a good trade, I feel, if you're neutral, and they give you a little bit more management benefit over an iron condor because you've already paid the money out for those options. Okay, more management potential of an iron against an iron condor. All right, but the iron condor advantage is you get a premium up front right now with the margin requirement between the strike prices. With this one, it would cost a debit to enter. You're not getting the credit up front, so that's sort of a negative. So this is a positive, this is a negative if I went further out. Now your direct question is a 1 week short to 2 week long a good trade? I don't know, honestly. I would say that in this scenario, I see the benefit of sort of the safety and having the extra time to manage the position if needs be, but I can't tell you long term if just doing a 1 week out or a 2 week out iron condor with the same sentiment would perform better than the double diagonals. I honestly think it would. Because remember, in iron condor, you lose 100% of the two long options, but you're starting off at a high positive net credit. You got a decent net credit here, don't get me wrong. This one was able to be done at a net credit because we're so close in. That's a very good positive. And you have an extra week to manage where you could convert it to an iron condor if things didn't go as well as you hoped in the first week. That's a benefit. But I would say that if that was the case, if you manage this or just let these expire and did another one to create an iron condor, I think just an iron condor for next week and an iron condor for the following week would perform better. I'm going to jot this down for you, John. I'm going to do some testing on this next month. I'm going to do a comparison of maybe 5 or 6 different trades so we can see the short-term diagonal versus 2 weeks or so of iron condors on a few different stocks over a short-term period and see what we come up with as far as numbers to give you a better gauge. Okay, commissions are about the same, and so forth. But remember, one other thing I'll say about this is, for right now, I don't want to sound like a broken record, I'm not interested in this trade. Meaning I'm not going to open one today because the market's closed. But I'm not going to open one next week, and I'm not going to open one in the second week of January. And you're thinking of using SPX, not stocks. That's okay. Okay, I'll do iron condors on SPX. That's good. Versus these double diagonals. We'll get that available to you 10 days, 15, wow, by the 10th of January. I hate to put a time frame on myself, but I'll say by the 10th of January. Next week's going to be a short week. Got some other things to wrap up. Got some other webinars to plan for, but I'll get into that, see what I can come up with for you, John. Okay? But we'll look at that comparison. But even though you're saying you're going to do this in SPX, I'm not doing any neutral strategies right now. I want the market to show me what to expect. Remember 1 year and 2 years ago, January to February, what happened in the market? This is not a strategy if that repeats itself. I'm not saying it's going to. I'm saying I'm going to wait to see. And we shouldn't really expect anything except the unexpected. But we shouldn't expect a major change in market conditions unless everyone decides to take a breath, pull their money out, move it from one type of security or one type of sector into another all at once, closing everything out for 2017 and then opening their new allocations 2 days, 3 days, 4 days into 2018 for buy and hold and stay. Changing a complete sector could change a complete index price. We don't know. So I'm going to wait. I'm going to wait for about 5-6 days into the first, or at least maybe 2 weeks into the first of 2018. See what the market is showing us before I try to do a neutral spread. I'm actually not even opening any new bull put credit spreads or bear call credit spreads next week. I closed most of mine out today that were still weekly experiences. Most of them were closed out last week or expired. So I'm playing a waiting game. I've got my married puts open. I've got a couple collars. I do have the diagonal spreads that I trade open, John, where I've got some March long calls, and I've been selling calls against them either weekly or standard monthly. I'm still neutral to bullish on those stocks, even if the market corrects, at a decent profit on most of them. But if the market starts to correct, I'll close those positions because I'm leaving myself open for too big of a loss. Okay, so those are my thoughts. We'll do some comparisons for you. We'll take a look at them. Some of you heard me say before in the webinars when we did our series on calendar spreads, criteria, and using the calendar spreads. It's available in the webinar section there under the option strategies. I trade calendar spreads regularly. They're one of my favorite strategies to trade, but I go in and out of them often enough because sometimes they're very successful, sometimes they're not very successful and result in large losses. Okay, I've tried. When the weeklies came out many years ago and when there was more availability for the weekly options, I tried to develop a good strategy and consistent profitable strategy for calendar calls and calendar puts with selling 1 week out and buying 3 weeks out. Selling 1 week out, buying 4 weeks out, selling 1 week out, and selling 2 weeks out. And I was using stocks. I wasn't using a standard index. I was trying to find a good strategy with a set criteria for the stocks that worked over most market conditions with the different, short 1 week, long 2 weeks, short 1 week, long 3 weeks, short 2 week, long 4 week, and so forth. And I just could not get anything that was consistently profitable better than what I have been making in the past several years by buying an in-the-money call, the stock I'm neutral to bullish on, 5 to 6 months out, and then selling monthly or every 2 weeks if weeklies are available against it. I couldn't outperform the performance I already had using the shorter term positions. I know it sounds strange, maybe picking the wrong stocks. I need to pick faster growth or just stay in the indexes, John, as you're doing, which is a good piece of advice at any time with these type of leverage strategies. Could have been my downfall. But I wasn't able to create a good structure that I was consistently comfortable and profitable with, trying to build these shorter term diagonal spreads, 1 versus 2 weeks, 1 versus 3 weeks, and so forth. So I don't know what to expect for the market. I don't want to get trapped right now with that. So I'm not opening any kind of neutral iron condors or positions at this time. All right, David's going to lead us into the radioactive trading techniques here. As many of you know, we've shown the advertisements that we have that end of the year offer for the blueprint with the 8 special bonuses, including no shipping if you pick up the blueprint, plus access to several of the Mastery Series videos that are going to be coming out soon, and in addition to that, the money back guarantee. But that's all based on this structure of buying a stock and buying a put option that's 5 to 6 months out in time to ensure the position. And David's question, I'm sorry, it was David. Yeah, David's question says, any suggestion on guidelines as how you trade a RPM with an earnings report forthcoming? Your trade is not bulletproof, meaning I haven't canceled the risk, and you want to stay in the trade for growth, so you would not use income method number 3. And let me talk about what I mean by that. You would not use income method number 3. That's right, because you want to stay in it longer term. Okay, so I'm going to break down some of the Radioactive Trading's position. Oh, I'm sorry. Before I do that, my apologies, John. I completely forgot about it. We got involved. This checkbox here for always use current market prices. When you go into view options, to select an option, you know, I don't even think this is needed anymore, to tell you the truth. I'm going to have to talk to the programmers about that. See, we recently updated this, that when you enter an option, so I'm going to do a calendar. I'm not even going to look at the statistics or the criteria, but I'm going to go with the 150 call, kind of expensive. And I'm going to sell a 14-day out, 170, 250. All right, so this would be a diagonal spread that I would build. Not saying it's better or worse than what John's doing, just this is what I would do. Okay, so now when I enter that, it automatically does the bid price and ask price and puts in the midpoint for me to calculate the return. Before we had the midpoint in there, John, we had customers who were building similar SPX iron condors on the fly, where they were going so far out of the money where you had a bid of 0 or close to 0 or 1 cent and an ask of 0.5 cents for the option they're selling. And the option that they're buying was a bid of 1 cent or 0 and an ask of 6 cents. So before we put in the midpoint, if you added that in, it would automatically put in the ask price for the long at 6 and the bid price at 1 for the iron condor. Now, let's say this was 10. I'm sorry. Let's say this was 1 cent to 10 cent. Now, if you got midpoint, you're closer to 6 cents here and 4 cents here, so you get a 2 cent net credit. Now, what was happening, though, is that investors would put this in, a deep out of the money option, and it would come up with bid of 0. So what we did by always use this box, always use current market prices, instead of looking at the current bid and ask, it would look at the last trading price. Okay, current market price is last trading price. So if you were trying to enter a spread on the fly, it wouldn't grab the 0 as the bid. It would look for the last fill price on that position also. Okay, so that's what that's referring to there. But now that we have the midpoint, I don't think we need it. Thank you for pointing that out to me. All right, so that being said, let's go back to the married puts. And you know what? I'm going to go here. I'm going to go to Planet Fitness real quick. I know it's a position that I'm in as a long collar, but we're just going to look at the profit and loss chart for this one. This is an actual trade. It sold a call on it yesterday and it pulled back, but I am going to close the position if it drops below 33.75. In any case, before I sold the call, this was the position. It was a bulletproof position, meaning no risk. Now, what David's saying is he's in a married put where earnings is coming up and he's not bulletproof like this position is. So if I'm bulletproof and I have earnings coming up, I may leave it alone, or I may actually at this point, so this is my February 30 put, what I might do at this point, let's say earnings on Planet Fitness were coming up on January 10th or 11th, I might buy a 35 put in my case. In that scenario, instead of rolling this up to the next strike, I might buy a shorter term, cheaper put to create a synthetic strangle almost that has no risk. So if the stock falls and drops back down to, has a disaster to earnings and drops back down to 28 or 29, rather than accepting the 8% profit, I might make more. And I still have a good, reasonable upside. But what to do if you're in a married put, you have earnings coming up, okay? And let me go back here. real quick. So I'm going back here because I want to see the earnings coming up. Let's see if there's any good stocks that have earnings coming up. Nice, reasonable company name here. Walgreens Boots Alliance. Not a lot of movement on its earnings, but let's take this one. WBA. Earnings coming out on the 4th. And the stock's at 72.62. So let's check out Walgreens Boot Alliance. I want to check out the chart. I want to find a good entry point. Good. December 1st. How about it? Okay, so what I'm going to do now is go back in time. Oops. Yeah, here we go. I'm going to go to the option chain. I'm going to go back to December 1st. Okay. And it's at 71.45. So I have a small gain in the position, about $1.20, but not much. Okay, so we're going to say we're at 71.45. We enter the stock. Oh, let's enter it the day before. Let's go to end of, okay, perfect. Bought the stock at 72.76, November 30th. And at the same time, probably would have gone to April. Nope. Would have gone one further. Would have gone to June. All right. And I'm guessing I would have bought the 75. 75, we'll call it a midpoint of 665, and the 80, call it a midpoint of 825. Okay. So now let's go to our custom spread tool. I've got my numbers from the historical chain that I want to see. I'm going to try that first one first. Okay, so on November 30th, we entered WBA, Walgreens Boot Alliance, basic 100 shares with a cost basis $72.76. At the same time, let's see what would happen had I bought the June. I'm trying to stay with the 75. And at that time, the 75 was at a price of $6.65 is what I said at midpoint. Okay. So first thing I want to do is, 5.6% risk. I'm staying with the 75. Okay, good stuff. I'm going to add this to the portfolio real quick. And we're just going to go ahead and call this our earnings RPM. Okay, now I just want to have that in the portfolio there. Oh, change date, sorry. Okay, so all that aside, where are we? We're in a position that we originally had a risk of 5.6%. Over the time we've been in the trade, we've lost 45 cents of time decay to the put. At the same time, we've lost 14 cents on the stock. So right now we're down about $59 or 0.7%. Not much for 30 days. We might have done a management technique in between here at some point, sold a 75 call. Let's say we didn't. Okay? All right. So, okay, sorry about that. Now, what are we going to do with earnings coming up on January 4th for this position? We have no gain or no loss. We're currently at a little bit of loss of about $59, 0.7%. Now, one thing I do recommend, David, you want to stay in this longer term. No problem there. But an option I could do to lower the risk going into earnings right now, even though I've lost money on the put, I could sell the June 75 and buy, to cross earnings really short term, the January, and keep the same strike, 75. Okay? So I'm going to roll it, and as you can see, we're basically going to get about $6.20 for selling our June put and buying the January at 3.30. So we're almost generating $3 worth of premium to lower our risk down to only 2%. That doesn't solve David's needs, but it's something you can do if you have no gain or loss on the position really, or no real change on the position, and earnings are coming up, and you want to kind of cancel the risk without taking too big of a loss on the trade. Okay, so that is something that you can do. Now, you don't want to do that. but we're coming up to earnings, we're coming up to the unknown. What is another thing you could do? And this is what blueprint owners are going to see with the new Mastery Series video. Well, this is a taste of what they're going to see. I would consider possibly doing an income method number 12 in the shorter term. So I might just go to January. Well, the stock's still staying where it is now. These prices are inflated because of the earnings coming up, okay? But I'm still only paying maybe $1.30, $1.50, or so forth. Based on what you think is the worst case scenario of the position, I don't know if I'd want to buy it at the money. I might buy, honestly, a 75 put again, but this is for shorter term. It's going to cost me $3.45 to get into the position, but what's the advantage? I'm paying $3.30, but remember this option is $2.30 in the money, so I'm paying really about $1. If the stock, here's the problem with this one. I agree with that because we're not right at the strike. But if the stock moves up to 75, I take a maximum loss. But that's okay. I can close this put, still leave this open. Now I've got other opportunities. If the stock falls 69.68, if it drops 3 points, my position's at break even because of the gain of this put and the gain of this put. I've doubled my delta. Now, you could say, well, instead of paying $3.30 for this, could you buy an out of the money put? And it did lower the overall risk down to 3.5%, right? But you could possibly reach that if the stock hits up to 75. But then again, you'd have other opportunities to manage that position. I'm paying as cheap as I can. But let's go the other way. Let's go back to January. Was that January 12th? I think I was. Okay, we'll go back to standard, or 2 weeks out, I'm sorry. Oh, no, I must have been out. I was to go to the 19th. Yeah, I was at the 19th. Okay, so I'll stay with the 19th. I could buy a cheap 70 strike put for only about $1. That's true. For the shorter term. So we'll just buy one standard 19th of January, so it's after the earnings, and a week or so after the earnings for further management. The stock continues to move down. It can work in our favor. Now, this keeps my risk at about 3.6%. That's, of course, looking at January expiration, not June. The break-even, though, goes down to 65.77. That's a 7-point drop. It's a little bit steep. But the worst case is if the stock's at 70, if it gaps up to 75, this 70 put that I just bought cheaply would likely expire worthless or go to zero, but that's fine because now the stock's up near 75. I can do the other income methods I was planning on doing with the stock near that price. Okay, so adding an extra put, shorter term, one direction or the other, weigh the benefits to you and see which one best suits your needs. Now, can I get a no-risk extra protection? Potentially, but with a caveat. So now I've got a synthetic straddle. Stock falls, here. I don't know. It's hard to say. I'd probably go with this. At this point, I'd probably buy the 72.50, actually. I'd probably buy the 72.50 right near the stock price. So if it gaps up, I didn't give up too much. If it falls down, I'm right near the price where that delta can start working for me to the downside. That might be the better choice. But again, I could potentially generate premium here to help pay for this $1, but I want to leave the upside open. I don't just want to sell a 74 or 75 call, let's say the 75 call for $1, because that would cap the upside. But what if you add this extra put by income method number 12 and now do income method number 6, the bear call spread, selling the 75 and buying the 77? You're not going to get as much credit, but you're going to cut down half of the cost. So I paid $1 here. I sell the 75 for about 96, 97 cents. With midpoint gives me $1.12. And I pay 56 at midpoint for the 77. So I generate 56 cents, half of what I paid. But, I still have infinite upside if the stock goes up to 77 or 78. But now this lower break even, it cut the cost down, it cut the risk down. But in this little window, I'm sorry, you guys can't see that. Between this little window, I don't get back up to profitability. I'd like this to be positive and this not to be. So that's an idea of how to pay for it and leave the upside open, but you're expecting a larger move. I think this is a combination of 12 and 6 around earnings, which I've done in the past. But in this case, I'll probably take that off. So yes, you're putting more money in and you might lose all of that value that you put in, but you're setting it up for a structure that if it swings either way fairly reasonably, not a lot, 7 points to the downside here, yes, that's why I think I'd go with the 7250, or just up to 7608, that would increase to maybe 7750, 7780 or so. There we go. So that's what I'd kind of consider there on those strategies. That's another idea. You could just do income method number 6. Okay, I'll just do it straight out with the near-term January. I could do the weeklies, but I'm going to sell that 75 again, and we're going to buy the 77. We'll cut our original risk down by 56 cents. So I've lowered my risk to 4.9, and I leave the upside open here because this graph would continue to move up. So your considerations are, without using income method number 3, is considering using IM12. You can see that in, that's contained in, I apologize, income method number 4, the chapter of income method number 4. It's one of the alternatives there, but consider a 12 around earnings, combination of 12 and 6, or just a 6. And that's only if you don't want to roll the put closer in time. Income method number 5 caps the upside, 1 caps the upside. I wouldn't use any combination. 8 is neutral and 7 is neutral. You're not going to do those. 11, a little bit too unnecessary complication. It doesn't match the SIGA model for coming into earnings. So it would be 12, 12 and 6, or just 6 based on what you're looking to accomplish. What are your goals? What risk are you looking to minimize as well? Okay, that's why I consider with a married put going into earnings. If I don't have that, I'm sorry, if I don't have any gain and I don't want to shorten it as well. Okay, now let's see. Sam had commented on some of his trades. He had a big trade on Watts. He was doing lagging options, I think, on Apple as well. He sent me some other screenshots he's been very successful on at as well, but he unfortunately left a moment ago. With his comments, he had to leave the webinar, I guess, there, so I don't know if he's going to be able to join us again there. So he's listing some of his positions, and of course he listed what he wants. Now Rajiv, a couple questions here from Rajiv. Let's go back here. Okay, so Rajiv says, I bought a diagonal calendar call on US deal, sold near term 36. Okay, so let's get that going. That's X. You sold a near-term 36, and 2 weeks later, 35 call. Now, suddenly, at the end of 2017, U.S. Steel fall with other stocks. Should I be worried and close my position on Tuesday? I'm still in the money now. Okay, so you sold a, was it 36, 35? Yeah, okay. So we've got I guess you sold this naturally since we're still in it. You sold the 36 call here, and 2 weeks later, 35. All right, so if I got in at today's prices, your prices were different. There we go. The stock's at 35.19. So we're looking pretty good right now. This is a call, right? Yeah, diagonal call. Okay, and okay, sorry. Okay, so in this case, naturally you have to wait till Monday's reaction anyway, but I'd wait to see what happens on Monday. I wouldn't try to roll this call down. You could buy it back cheaply and maybe roll to that 35.50 in here. I wouldn't do that because if it recovers, you likely are only going to have a very small profit. It might not be worth it to you if it starts to get profitable. So naturally, you got to wait to see what Tuesday offers. Again, what your thought is here is that you go and say you tried looking for an at-the-money call or put for a few shares and premium wasn't there, right? Because volatility is dropping. That's what we used to see. But seeing a big stock movement without volatility like Google or Amazon, shares to control volatility is lowest. Is this the reason we're not seeing big premium recently? Right. Big premium may come back if there's unexpected shifting in 2018 in the first week or two, which could cause this a problem. Or you might see movement upwards. Again, I don't know. That's why I said I don't have any spreads open for this weekend, and I'm not opening any iron condors or directional spreads for the first week of next week either. Hard to gauge. So if you're concerned about it based on what you see on Tuesday, I'd buy a short. I would consider not selling anymore, okay, because you just enter an obligation that can get you into more trouble if this continues to fall. But depending on what happens Tuesday, I might consider buying a cheap put, maybe even the 34. I know it's going to change the whole dynamic of this trade, but, it gives you this little blip where you can still have a profit if the stock goes up to 36, and if the market really starts to fall in this stock, hard to say, but in the next week, if it was below 33.14, you start to recover and have a profit. And the mid-range here, of course, is that. Might not be the position that you want, and you could say, well, I could augment this by selling another put, but remember, I'm not looking 2 weeks out, I'm looking 1 week out. I'm just looking for short-term protection if it does fall. It doesn't look like this would give you the profit and loss chart you want, although it would have a profit here, but if it moves back up, you enter back in the loss zone. So I don't know if that's an idea. Now, you could add a bull put spread to it. That's just complicating things now. Okay, so you bought the 34 put. I don't think you'd want to do this, but if you expect it to go back up, you buy the 34 put, sell the 35, but this isn't going to give you the graph that you want. Right? This is now you're double dipping on two bullish spreads where you could lose on both of them now. Okay, so we're entering a bull put by selling a 35 put with a stock at 35.19 and buying the 34 at 21, so you get 30 cents additional net credit, but all this is a double dip on a bullish spread. You increase the profits to the upside, but if it falls, you're going to lose twice as much as you would have just leaving the diagonal open, okay, the short-term diagonal. Rolling the call down. Oh, shoot. Sorry, folks. I apologize. That wasn't supposed to happen. Rolling the call down is not going to give you, I don't think, the graph that you want to give you more breadth to the downside, but it would lower the potential profit. So if I sell to close my 36 at a cheaper, sell to close the 35 at a cheaper cost I bought it, and then buy a 33 or 34, all I'm doing is increasing cost, and you'd see the pinnacle. Oh, sorry, let me resubmit that. You'd see the pinnacle of your max profit here start to dwindle. It would drop down to maybe only 20 cents or 25 cents. So wait on Tuesday. If it recovers a little bit, you're looking good. Naturally, you want it to be around 36, 36.10, 36.20, maybe even 35.80 or so. So you want that to come back up. If it continues to fall, consider adding, not selling, buying that short-term put. And I would not recommend selling another 36 call for a cheaper price. So I might get an average price of 25 or 22 cents here. If the stock continues to fall, you sell an extra one. Now you're in that ratio call spread where you lower the risk to the downside, but if it recovers, you've got infinite loss to the upside. So this is a broken wing butterfly. Well, yeah, if I add an extra far out leg here, see, now it's just getting too complicated. Now it's just too many working legs to try to repair a simple diagonal spread where we'll have to say, you know what, if it does start to pull back also on Tuesday, maybe I should just liquidate the position. Okay, maybe I should just get out of it. Because if it keeps falling, you could try to repair it. You can pay more money to buy a put to repair your diagonal. But now you're making it more complicated. Now we jump into the idea of the double diagonal. So I sold twice as many here, twice as many calls. I've got this 35. Go to January 12. Oh, let's buy a cheap 40 call. Why not? So now I've got two short calls, a January 12th 35 call, January 12th 40 call that I've bought, and you're pretty much same kind of thing. Right? Now you've got infinite risk to the upside here. The max profit is shown here. The max risk, of course, to the upside. I'm sorry, it's not infinite. But you've taken on a higher risk here to the upside at 372 as opposed to what you originally had. Okay? Oh, come. Sorry, folks, it never changed over. I apologize. So let me just do that real quick. Well, we had mentioned that the ratio, seeing that ratio, the selling the 2 and buying the 1 here probably doesn't give you the graph that you want because it increases a risk to the upside. Right? You don't want to do that. Buying it, as I mentioned, buying the farther out wing now, sort of what would create a broken wing butterfly. I'll go to January 5th instead, but we go further out on the call for a cheap price. Let's go to the 38 call. So what do I have? 2 short 36s, 1 long 35, 1 long 38 with a close expiration. Still not, you get a little bit extra premium kick here, but now if it recovers, your break even is at 36.54. And you're still losing at 34.84, just you've canceled some of that loss. I don't know if that's worth it to complicate a diagonal spread by trying to repair it to create a 4-leg spread or any form of ratio where you're short twice as many as you're long and then try to add another one to create a butterfly. I just don't think that's a good way to go. Wait until Tuesday, see what the market gives you. Again, if it pulls back and you think it's going to continue down, consider buying that cheap put for the 5th, or the 12th, either one based on what your expectations are. Consider that view. If it moves back up, well, you're back to where you kind of want to be. We want to be in your original position. I am sorry. You want to be in that original sort of 36.10, 36, 35.80 range for the position on your diagonal spread that you have, the short-term diagonal spread where you sold the January 5th 36 and bought the 35 for the following week. Whoops, let's get that out of there. Here we go. Okay, much better. Okay, so that's where we're looking at. You want to be in that range, and you saw the effect that those changes would have on the position also. Now, this is based on my prices, but you could see that too. So, Mark came in late. He just came in a few minutes ago. Mark J came in and he says, Tess, yeah, Mark, we see you. We were just covering up Rajiv's topic there based on the question that he sent in. Hopefully you're able to see the screen there. You jumped into a conversation on short-term double diagonals and short-term diagonal positions with selling a near-term and buying 2 weeks out. Then we also covered earnings around the radioactive trade married put positions. All right, ladies and gentlemen, we are at 5:45 Eastern Time. The Mark just joined us, Mark. So if you have a question you wanted to ask, just use the question pod to send it to us. We'll see it. If anyone has any other last-minute questions, go ahead and send those in. Otherwise, we'll take a wrap up here. Hold on one moment. Sorry about that. Needed to get a drink of water real quick. Okay, let's see. I think we do have another question that came in, and it was from Mark. Mark, I haven't looked at it. Mark, anyone who wants to chime in on this, feel free. Mark says he was late, came in a little late. Do you have any opinion about the last-minute drop in all of the indexes in the market? No, I'm sorry. I didn't actually look at that at about 3:30, 3:45. Between 3:30 and 3:45, I was working on some other presentations and some other material, and I had already closed out most of my positions, and I looked at my 2 radioactive trades and my 2 calendar spreads that are open and 1 collar. No, it's 2 collars and 2 collars, 1 calendar spread, and the 3 married puts I have open. Sorry, this is not doing any directional spreads right now into the new year just because I don't know what's going to happen. But my positions didn't move that much, honestly. The indexes moved. I will say that when we looked at Planet Fitness, or that did move. The last time I checked Planet Fitness before the market closed, the stock was at 30. It had pulled back down below to about 34.70 and had gone back up to 34.95, and then it dropped to 34.63. To me, that's nothing. It's just a drop in the bucket. That was most of the changes, 25 to 30 cents I saw in my positions. A little down at the beginning, rallied back up, and then came back down. But all of them were just drops in the bucket. It didn't affect my positions really much at all. So I wasn't overly concerned without that. So I'm not quite sure. Eventually, Sunday or Monday, you'll start to see the articles that people post about what does the market hold based on the futures, what people are seeing in the futures. And the futures market might be a place to check to what we'd expect to happen on Tuesday when the markets open back up. But we'll go ahead and wait to see what the global markets do and everything else. I mean, it might just be a small depression of money being pulled out for tax purposes before the final bell in 2017. And then we talked about this a little bit, that the unexpected of 2018 is we might see money moving from already pulled out of sector A or sector B or index A or index B, and then going into a new index or a new sector start of 2018 based on what investors' projections are going forward. So you might see pullbacks in the NASDAQ and an increase in the Russell, or something along those lines. So it'll be interesting to see what happens in the first 5 to 10 days. I had a conversation with a customer. He referenced a study that was done. I cannot remember the name of the company that did the study, but it was something along the lines of if the first 5 days in January are up 80% of the time over the course from like 1935 to now, but if the first 5 days of January are up or end up after the first 5 days, the market ends up from where it was at the end of the first 5 days of January. Now, it's usually an indicator of a positive year. If the first 5 days are up and January as the month of a whole is up, it's an indication of potentially a, on average, 10% growth or something along those lines. But if it's down, it's indication of a down market. And if it's down in the first 5 days and down for the whole month of January, 73 some odd number percent of the time, it usually means the market will lose 50% of what it had gained previously. I didn't know the study. I haven't read the full study. It's just something that he had told me. So I always do that anyway without the study. I usually pull most of my positions out unless they're bulletproof trades or protected married put trades, and don't enter anything new until about the 7th or 10th of January, depending on how the calendar falls. And that's simply because I don't know what's going to happen and I want to wait. And of course, I don't know what's going to happen anyway, which is most of the positions I'll open in January are going to be married puts or collars or a deep in the money diagonal spread or something along those lines. Okay, is what I'll look for. All right, so, oh, sorry, this is the Planet Fitness trade. It's bulletproof, so I'm okay holding it. I know exactly where I stand on my other married put on CFG. It's at a loss of about 2% with expiration 20 days away. I'll probably close that in the first week too if I can get any type of profit out of it. And then AMAT's not doing what I want, but that married put, I've got a small loss on, but it can't go much higher. I think I'm losing 2% and I could max lose 3%. So even if the stock falls 10% in the first 5 days, I'm no really worse off than I was. But if it goes up 5%, 10% in January, I'm going to be at a profitable position where I'm at a loss. So I just left those alone. It's the diagonal spread I've already paid for. And we talked about the long call. I have been selling calls against it, so I've essentially already paid for that and protected it too. And my collars are just for January expiration. So that's it. I'm not opening anything new for the first 7 days of January. But I've got a few positions open already. All right. Well, ladies and gentlemen, I don't see any other questions that have come in. Of course, I just want to remind everyone there, if you haven't done so, you saw all of my emails this week. Most of you did, about the special year-end promotion that'll end on Sunday for the blueprint, the limited risk trading, the blueprint, the radioactive trading. You go to radioactivetrading.com/EOY, and you'll see the offer for the 8 special bonuses, the 2 discounted months of fusion for only $10 a piece. One of the Mastery Series videos, one of the 6 Mastery Series videos. You'll also get the new 7th Mastery Series videos for free in January if you pick up the blueprint. We've got some other good things in there, plus free shipping, money-back guarantee, and more. So if you're considering that limited risk strategy we saw today, a little concern of that, a little the married put position where we saw a couple adjustments you could make going into earnings, even if you don't have a gain, to put yourself in a better position with the unexpected. Check out the blueprint. Go to radioactivetrading.com/EOY, or just go to radioactivetrading.com and click on the products tab there in the blueprint. You'll get a review of the bonuses that are available. No shipping, money back guarantee, plus the other bonuses are yours for free if you decide to return it as well. Okay, and if you haven't done so yet, remember you can go to Power Options at any time. No, I'm sorry, screen shifted on me again. By my own fault. But you can go to Power Options at any time if you haven't done so yet. Just go to powerop.com, put in your first name, last name, and email address, and you can take a 14-day free trial there as well. So it'll give you full access to the site. We saw today for 14 days also. The subscription levels after that start at $40 per month for our end-of-day data service. We do offer a delayed service, of course, it's $6, and a real-time service, and then you could upgrade to the historical tools from the delayed and from the real-time as well. And of course, you think of any questions at any time, remember to send me an email to support@powerup.com or support@radioactivetrading.com. You can call us during office hours at any time also. Mark added that I wish to admit I'll finally be buying the blueprint, been thinking about it for 6 months. Well, good stuff, Mark. Get your order in there if you can this weekend, and you know, you'll get all the bonuses to you, but get your blueprint shipped out. And then, of course, if you have any questions about it anytime, you know where you can find me during the trading day or on Fridays after 4:30 p.m. as well. So we'll be more than willing to help you out with any questions you have. Ladies and gentlemen, have a happy new year. Have a safe weekend and a safe new year and a very happy new year as well. We'll see you all on the other side into 2018 for our next presentations, our live presentations, as we always do for radioactive trading and power options. Take care, relax, made it through this trading year, one more trading year down. Excited to see what 2018 brings us and excited to see your questions and the comments and what we're going to see in the markets going forward. So take care, everyone. Good night.